Dear students, welcome to our channel. In this video, let us discuss about marginal costing, an important topic in the cost and management accounting. Marginal cost, breaking the title margin, cost, marginal costing. In your organization, you produce few number of units and you decide to add up few more units. This is margin. Cost, it is the sum total of all expenses involved in the conversion of a raw material into finished goods. You pay money for the purchases of raw materials, you make the payment of wages, all these constitute to cost. Marginal costing, it is the change in the cost due to change in the production units. Say for example, for the month of April, you produce 10,000 units and you incur a cost of rupees 1 lakh. In the month of May, you decide to double your production to 20,000 units and you expect the cost to be doubled, that is rupees 2 lakhs. But the reality is the actual cost may be rupees 1 lakh 90,000 or rupees 2 lakh 10,000. Why the cost is not proportionate with the number of units produced? Let us break down the cost aspects. The electricity bill may be rupees 8 per unit when you produce 10,000 units. But the electricity bill will be rupees 10 per unit when you produce 20,000 units. Electricity charges are based on the slab rates. You consume more, you pay more. When you produce 10,000 units, you purchase the raw materials, for example, rupees 4 per kg. When you double your production, you make a bulk purchase and you request for discounts to the supplier. So the raw material cost may come down to rupees 3 per kg. So one component of the cost may increase, the another component of the cost may decrease. This is the reason why the cost is not proportionate with the number of units produced. So it may lead to an 10,000 favorable situation or 10,000 adverse situation. This is marginal cost. So marginal cost, it is to understand the changes in the cost due to the additional units produced. It is a tool or a technique applied to know why the cost is not proportionate to the changes in the units produced. To understand the marginal costing, firstly, variable cost. Variable cost is that changes for different levels of production. You produce more, you have to spend more. When you produce less, your cost comes down. Such cost is variable cost. Example, raw materials and freight charges. Fixed cost, this cost remains constant for all levels of production. Whatever may be your number of units produced, the salary that you pay to your admin staff or the rent that you pay to their building all remains same. Such cost is fixed cost. Marginal cost statement. This is the most important aspect of the marginal costing. It starts with sales. You deduct the variable cost, you arrive contribution. You deduct the fixed cost, you arrive profit or loss. Let us discuss three situations. Firstly, sales is 1 lakh. You deduct the variable cost of 75,000 and the contribution is 25,000. Deduct the fixed cost of 15,000. You gain a profit of 10,000 rupees. Another situation where sales is 1 lakh and variable cost is 90,000. You get a contribution of 10,000 and from this you deduct a fixed cost of 15,000 where you incur a loss of 5,000. The third situation, sales is 1 lakh, variable cost is 85,000, contribution 15,000 and deducting the fixed cost, you do not get any profit or loss. This is a situation where no profit, no loss. It is termed as break-even point. So, break-even point, it is a minimum sales target for any organization that they have to achieve in order to avoid the loss. Break-even point, it is a sales level where there is no profit, no loss. Or break-even point is that situation where your contribution is just sufficient to meet out your fixed cost. Some key components of the marginal costing. Margin of safety. It is the actual sales above the break-even sales. This is a tool that helps us to understand how far the company is safer with regard to the sales performance. The two important ratios, profit volume ratio, that is contribution divided by sales into 100, variable cost ratio, variable cost divided by sales into 100. Adding these two ratios, you will get 100. When the sales is known and you want to know the profit, in that case you have to prepare the marginal cost statement. And the situation is reverse. First you fix the profit, that is you have a desired profit and you are interested to know what is the volume of sales to be done to achieve that profit. For this you have to apply estimated sales formula. Some important formulas in marginal costing. Firstly, break even point. It is a situation of no profit, no loss. Here fixed cost divided by contribution into sales. Then fixed cost divided by profit volume ratio, or fixed cost divided by contribution per unit. Based on the available details in the given question, you can apply any one of these three formulas. The next is the estimated sales. You fix the desired profit and you want to know what is the sales volume to be achieved to get this, to earn this desired profit. The same set of formulas that you applied in break-even point is to be applied, just adding the desired profit to the numerator. Add the desired profit to the numerator and apply any one of these formula based on the available details. You will get the estimated sales. Then margin of safety. It is a sales level above the break-even point. Repeat the same set of formulas for break-even point. Only thing is, in the place of fixed cost, you replace it with profit. These three formulas help us to arrive the margin of safety. The first two row formulas will help us to arrive the value in amount value. The third row formula will help us to get the value in units. Let us discuss some practical questions. In the first question, we are given with the details about two companies, company A and company B. Starting with the marginal cost statement. Company A, sales 5 lakhs, variable cost 3,50,000, contribution 1,50,000, and you deduct the fixed cost, you get a profit of 30,000. Repeat this process for company B, you get the profit of 30,000. So first question is answered. Profit for both the companies are 30,000 and 30,000. Second question, profit volume ratio. Profit volume ratio is contribution divided by sales into 100. For company A, the contribution is arrived as 1,50,000 and sales is 5 lakhs. You divide this and you get the profit volume ratio as 30%. Same way for company B, the profit volume ratio is 40%. Break-even point. It is fixed cost divided by profit volume ratio. Break-even point for company A, we know the fixed cost as 1,20,000 divided by the PV ratio of 30%. You get 4 lakhs as the break-even point for company A. For company B, 1,70,000 fixed cost divided by 40% of PV ratio, you get a 4,25,000 break-even point for company B. Margin of safety. When you know the actual sales and break-even sales, just deduct the break-even sales from the margin of break-even sales from the actual sales. So margin of safety for company A is 5 lakhs minus 4 lakhs, you get 1 lakh. Likewise, margin of safety for company B, actual sales of 5 lakhs less break-even sales of 4,25,000, you get 75,000. Comparing these two margin of safety, company A is much safer than company B. Though it seems though companies are earning the same profit, company A is at a safer zone. Second question, we are given with some details starting with the marginal cost statement. Selling price is given as 10 rupees and a trade discount is given at 5%. So it is deducted from the selling price. So the actual selling price comes to 9 rupee 50 paise. We are given three variable cost components. Direct material 3 rupees, direct labor rupees 2 and other variable cost. It is 100% of direct labor cost, that is 2 rupees. Deducting these three components from the selling price, you get a contribution per unit as 2 rupee 50 paise. The first division of the question is break-even point, which is fixed cost divided by contribution per unit. This formula will give us the value in units. So 10,000 fixed cost divided by contribution per unit, it is 2 rupee 50 paise, it is 4,000 units. The second part of the question is to find out the profit when the sales is 10% above the break-even point. We estimated break-even point as 4,000 units. Adding 10% of it, 400 units. So the new sales is 4,400 units. Contribution per unit we arrived as 2 rupee 50 paise. So the total contribution for 4,400 units is 11,000 rupees. We know that deducting the fixed cost from contribution, we will get a profit. So here 11,000 of contribution less fixed cost 10,000, the net profit is 1,000 rupees. The next component is we have fixed the profit, that is desired profit as 5,000. We want to know what is the sales to earn this profit. So estimated sales formula, fixed cost plus desired profit divided by contribution per unit. That is 10,000 fixed cost plus desired profit 5,000 divided by the contribution per unit. It is 6,000 units to achieve a profit of 5,000 rupees. Then third question. This question we are giving the details for 2 consequent years. In such cases, we have to first start with finding out the profit volume ratio. Profit volume ratio in this case is change in profit divided by change in sales into 100. That is difference between the profit values and difference between the sales values. So the difference between the profit volume is 25,000 minus 5,000. 5,000 is the difference amount. In sales it is 20,000. So the profit volume ratio is 25%. The first part of the question is answered. We are asked to estimate the variable cost. So we have to prepare the marginal cost statement. For the year 2025, we are given with sales of 1,50,000 and profit of 20,000. Whenever we know the PV ratio on sales, multiply it to get the contribution. So PV ratio into sales, we get a contribution, that is 25% PV ratio into 1,50,000 sales, we get a contribution of 37,500. And differencing the sales and the contribution, we get a variable cost of 1,12,500. Differencing the contribution and profit, we get a fixed cost of 17,500. Repeat the same process for the year 2026. 25% of PV ratio for a sales of 1,70,000. You get 42,500 as the contribution. Differencing sales and contribution, you get a variable cost of 1,27,500. Differencing the contribution and fixed cost, you get a fixed cost of contribution and profit, you get a fixed cost of 17,500. So the second part of the question, variable cost is estimated. Now break even point, it is fixed cost divided by PV ratio, that is fixed cost of 17,500 divided by the PV ratio 25%. The break even point is rupees 70,000. Now we fix the desired profit of 40,000 and the sales is to be estimated. So applying the estimated sales formula, fixed cost plus desired profit divided by PV ratio, that is 17,000 plus 40,000 divided by 25%. We end up with a sales target of 2,30,000. Now to know the profit, we are given with the sales of 2,50,000. Knowing the profit volume ratio on sales, you multiply that, you get contribution. So contribution is 25% PV ratio into sales 2,50,000. We get a contribution of 62,500. Deducting the fixed cost, it is 17,500. So we get a profit of 45,000. Margin of safety when profit is 50,000. So margin of safety, profit is 50,000 divided by profit volume ratio 25%. You get a margin of safety as 2 lakhs. We answer the last part of the question. In the next video, we will discuss more number of practical problems in the marginal costing topic. Okay friends, your like, share, comment and subscription may encourage me to post more such videos. Thanks for watching.